All right, now as Australians continue to grapple with the ongoing cost of living pressures, a new survey from the Mortgage and Finance Association of Australia has found that more than 80% of mortgage holders actually feel positive or neutral about their financial outlook, which represents a significant shift over the past year. So, what's driving this improvement in sentiment? Well, joining us to discuss is the MFAA CEO, Anja Pannek. G'day, Anja. Welcome to the Savings Tip Jar.
Thank you. Thanks for having me on.
Before we launch into this research, Anja, as we always do with our guests nowadays, we talk about savings tips. So do you have one for us?
I definitely do. So my number one savings tip is to make sure that you have a fantastic mortgage broker in your corner, because they can just make the biggest difference when it comes to lending needs, mortgages as well. So that's my number one tip.
It's a nice little tip there. It's good to have a first port of call too, like especially if you're a first home buyer, you're not really sure where to go. Mortgage broker can be a great option.
Absolutely. They just take, they take so much of the complexity out of what can be a pretty stressful and complex process. They're really proactive. I know my mortgage broker just, reaches out to me every once in a while and checks in. And what we know as well is, mortgage brokers more broadly across Australia have been incredibly proactive over the last 2 to 3 years, just because so much in the lending environment's changed. And if you've got a mortgage, you want to know you're on the best rate, you're on the best product, and they do an excellent job of that.
Yeah, there's got to be a reason why, about 80% of borrowers go through a broker. Now, getting into some of these findings, so you guys did a national survey of mortgage brokers, and you found that the number of brokers who said that more than 10% of their clients are stressed about mortgage repayments had halved over the past 12 months from 49% to 24%. What's driving this?
Yeah, so the question we asked is, how many of your clients, do you have more than 10% of your clients that are really stressed? And I think it's really important to remember the context in which we ask this question now and where many borrowers were 12 months ago. We went out in February, March of this year, and it was around the time that the RBA moved on the cash rate. So I think for the first time in a very long time, borrowers are actually saying there is relief coming. We've had a heightened interest rate environment in this country. We haven't seen the cash rate sort of that 4.35% now, I think since 2011 as well. So it's been a really heightened interest rate environment. Inflation's been high, cost of living's high. They're all key considerations. I think if you wind back 12 months ago, the cash rate was at 4.35, but that's really when it peaked. Inflation was a lot higher. And we just come through the Christmas period. If you think Feb 2024, most people would have been spending up big at Christmas, worried about what was going to happen next, and being hit with these repayments at really ultra high levels. So I think the environment, you fast forward 12 months now to February 2025, inflation's moderated a little bit. Employment is still really strong in this country. You've had some stage 3 tax cuts, some modest wages growth as well. And I think the other thing that's also been happening in the background, which is important to note, because this is a survey of mortgage brokers, is that mortgage brokers have been working with their clients around things like, can I get you a better deal with your existing lender? So even 5 basis points, 10 basis points, whatever the difference is, all of that makes a really big difference in terms of the household budget. And, mortgage brokers working with their clients around budgeting and debt consolidation. So I think a combination of all of these factors, as well as that outlook, where are we going? It should get easier on a go forward basis.
Yeah, we saw like a couple of years ago, nearly 3 years ago, actually, the first RBA rate rises in quite some time. And if we cast our eyes back to then, there were like 50 basis point rises, and it seemed pretty dramatic. Like every month, the mortgage holder was getting hit, and they were staring into the abyss of going, "Oh, geez, how much higher can we go?" It's a big hit to the budget, and then it kind of eased off, and there was no sort of movement for I think over a year, maybe 15 months, November 2023 to February 25, and that allowed, I guess, a lot of homeowners to absorb the impact over time and maybe have a bit of breathing room. How has it been in the sort of refinancing space since those times of 50 basis point rises? Because we're kind of chatting off air a little bit about how to keep the wheels greased, especially for refinancing and allowing those brokers to get better deals for their clients. How have we seen the sort of refinancing trends happen since the last few years or so?
So we saw a massive boom in refinancing activity when those, I think it was like well in excess of 1 million borrowers came off those ultra low fixed rates that they got during the pandemic and moved to variable. I think there was a lot of concern at that time around what was going to happen with mortgage stress because it was quite a marked shift in interest rates. One of the things we've looked at when we've surveyed our members over the last couple of years is how easy is it for someone to refinance? And because it was just such a prevalent factor in the lending market, and brokers facilitate, as you said, close to 80% of mortgages in this country. And actually, what we found this time when we went out and asked is it harder now than what it was 12 months ago? 12 months ago, we had something like 83% of mortgage brokers saying, God, it's harder than it's been previously. This time we went out and something like 42% said it's harder. Now, does that mean it's better overall? Well, I think we need to unpick that a little bit. There's still a lot of mortgage brokers saying it's about the same, and about the same doesn't make it better. So whilst there aren't as many refinances flowing through the system, that's really dropped off from the peak of that fixed rate wave, people are still looking to refinance. And I think what we're hearing as well from brokers is the RBA rate change in February really tweaked a lot of borrower interest. What should I do now? Does it make sense that I refinance? Our members are still saying that refinancing is challenging. And the number one factor really driving that is the serviceability buffer. So APRA's serviceability buffer hasn't really moved. It got set to 3% in October 2021, and it really hasn't moved then. So we've got mortgage brokers calling out that that's probably the primary reason when it comes to refinancing and inability to refinance overall. So I think it does beg the question more broadly around what needs to happen around that. Now, that doesn't mean that you can't refinance overall. It just means it may be more challenging for some borrowers.
Anja, you've answered my next question, which was going to be on the serviceability buffer, which of course I figured one way to certainly make that easier would be lowering that, because I do wonder whether it is still fit for purpose. Given it was put in place when interest rates were rock bottom, the cash rate was 0.1% or whatever, and there was every chance that the cash rate would go up by 300 basis points, end up going up more than 400 basis points. But the serviceability buffer has been in conversations a lot lately, because we've been hearing with this federal election coming up, both sides of politics mentioning it. We heard Jim Chalmers for Labor saying that he wants to encourage APRA to encourage the banks to take a slightly different approach when it comes to assessing HECS debts, and perhaps giving them a lower serviceability buffer, which we have now already seen with Commonwealth Bank announcing something similar. And then on the other side, you've got the coalition proposing to actually put the heavies on APRA themselves to lower that buffer from its current level of 3% to at least back down to 2.5%. So it's been interesting. But just wanted to ask you a little bit what you think about those policy proposals from both those parties regarding the serviceability buffer.
So I think as a principle across both, the buffer does need to be addressed. I think the first thing I've got to say is that the buffer served, I think, its purpose, and no doubt it really helped many borrowers weather the interest rate increases that we've seen from that ultra low 0.1% up to 4.35. So I think it's acted as a really good buffer. The question we've got to ask is are interest rates going to go up another 300 basis points, which is where the buffer is at the moment? We participated in the home ownership and financial regulation inquiry late last year, and we put forward a proposal that the buffer should probably be dynamic. It goes up where the risk is that interest rates will increase, and it comes down accordingly. So rather than just being what we see as a very blunt instrument, there's just a bit more flexibility in the buffer. I think we've got to take some learnings from what's happened with the economy and how borrowers have fared over the last few years and incorporate that into how the regulators manage systemic risk. So very, very supportive overall that, the buffer needs to be addressed. Also, when it comes to HECS, I think the way that lenders have been treating HECS has almost been overly punitive. It effectively reduces borrowing capacity. And HECS isn't like normal debt. It's paid from pre-tax income. It only clicks in at a certain income threshold. And, so it's quite different. So I think the adjustments that Labor have proposed around HECS and then what we've seen CBA do more recently, I think is eminently sensible. Now, there might be some people that disagree with me and say, oh, you're introducing a whole lot of systemic risk into the lending system. I don't think that's necessarily the case. I think what we're talking about here is that, a lot of people aspire for home ownership in this country. It's a very important part of what many Australians want to do. And what we're trying to do is endeavour to help them when it comes to home ownership through very sensible policy. Let's not forget that responsible lending is still in place. Mortgage brokers have best interest duty overall. It's very much addressing that sort of demand side of helping people get a foot in the door, which I think no one would disagree that's a bad thing. If I was sort of to zoom up and out around, broader housing policy, I think one of the things we all know is that there needs to be some fairly concerted policy to address housing supply. So any of the proposals on either side of government don't push up house prices, which would then appear counterintuitive to any demand side policies that you bring in. So I think we've got to see some movement on that with whomever gets into government in a number of weeks.
Yeah, I agree broadly that that regulators can be a bit too stiff and are reticent to change and be a bit dynamic. But we saw a couple of years ago a number of banks and APRA, I guess, had a gentle guiding hand with this as well. That like a number of banks did lower the refinancing buffer to I think 1%. And we were talking off air about just the so few lenders have actually enacted that 1% or 2 percentage point buffer. Can you talk more about that? Because I think like a lot of people are under the misconception that this buffer is mandatory, right? But I think banks can kind of act outside of those guidelines from time to time.
Yeah, so 3% is APRA's guidance, and then if a lender lends to a borrower outside of that 3%, generally it's regarded as an exception, and they need to report to APRA, and this is all in terms of APRA's mandate around financial stability. Lenders, as credit licensees, are also bound by responsible lending, and when RG 209, the guidance that ASIC has on responsible lending, was updated a number of years ago, we, the MFAA, participated in updating that and specifically looked at instances where it makes sense that a 1% buffer or another type of buffer could be applied. Some people might have heard of the phrase "a mortgage prisoner," like you're good credit, you've been making all your repayments, but you can't actually afford to. You're unable to refinance because when you take your current interest rate that you're paying and the 3% gets applied on top, you actually don't meet serviceability at the lender you want to refinance to. And we found a lot of instances of mortgage prisoners, in particular during this heightened interest rate environment. So RG 209, which I referenced before, responsible lending, allows for lenders to, for example, apply a 1% buffer. And we've seen, I think there's probably a handful of lenders, maybe 7 or 8, some of the majors, some others as well, that have said, yep, I will allow a refinance in. I'm using a 1% buffer, but the criteria, what we've found is the criteria for those are really, really strict. So it's dollar for dollar, no extension of terms. I think if you've got even the slightest blemish when it comes onto your sort of credit record, generally the lender will say no. And I think that's because it's outside of their policy as well. So, has it helped people? Undoubtedly, I think it's helped people. But I go back to what I was saying before, that I think it's really timely that the buffer B is addressed by APRA. And if it's to be held at 3%, there's some quite specific insights provided as to what's the reason for that when we're clearly in a downward interest rate cycle in the country.
There's so much going on in the world of mortgages and finance at the moment with this election coming up. But Anja, you've been very generous with your time with us, which we really appreciate. Thanks so much for your insights and your time with us on the Savings Tip Jar.
Thanks so much.
Thanks, Anja.
Okay, that's a wrap.